Hi there, eToro. It is Monday the 4th of September, and we will take a look at what moved the markets last week. But first, I wanted to talk a little bit about bond ETFs. A short while ago, you probably wouldn't have given a bond ETF the time of day, but things have changed. Interest rates have risen, and that means it is time to start looking at bonds as a potential area of investment. This is especially true because it is likely that the interest rate will start coming down somewhere in the next 12 months, and it should fall from there. And as you may know, the yield on a bond has an inverse relationship to the price. So if you buy a bond today and the interest rates are dropping, that means the value of those bonds will increase. Now, the thing about buying bonds is that it can be quite tricky. It's not as easy to buy a stock. They tend to be less liquid. You tend to have to put down more money. And the fees that you end up paying when you buy bonds a lot of the time end up being quite high. And that's why a bond ETF provides a nice alternative. Now, there are some differences between bonds and bond ETFs. A bond ETF is a bundle of bonds of various durations and risk levels that the fund manager has put into that particular ETF. When you buy a bond, you are lending some entity money for a duration in return for interest on the money that you have lent them. So this means when you buy a bond for a particular duration, whether it's 6 months, 1 year, 2 years, you're usually locked into that investment, that loan, until the duration of that loan expires, so it's not particularly liquid. This is one area where a bond and a bond ETF are quite different. You can buy in and out of a bond ETF as much as you want. And when you buy a bond, you receive the interest payment on the money that you've lent on a particular schedule. Quite often it's every half a year if the bond duration is more than 1 year. This is a little bit different from a bond ETF in that you get paid something akin to a dividend from the bond ETF, which is the ETF's way of mimicking the payout on the bond that you might have bought. I encourage you to look into the pros and cons of bond ETFs. For me, they feel like something that makes sense at this particular moment in time, especially for the bond durations that I want to be involved in. Now, it's not a risk-free ride. Any kind of investment carries risk. However, if you look at certain kinds of bonds, they tend to be a lot less risky than others. For example, US Treasury bonds, bonds sold by the US government, are considered just about zero risk. There's not much of a chance that the US government is going to default on its debt. Not yet, at least. So the bond ETF that I have been buying into for some time, and I think I'll continue to do this for the near term, is the iShares 7 to 10 year bond ETF. It is called IEF. You can buy it on eToro. And on screen it's represented by the candles that you see on the screen. And I've just also put up the 10-year Treasury yield on screen just to show that there is an inverse relationship between the two. So when the yields rise on US bonds, the value of those bonds falls, and vice versa. Before you buy into any bond ETF, you should also dig into the facts about that particular ETF. The company that owns that fund will have fact sheets with a lot more detail about that particular ETF, just like any other ETF, really. And some of the more interesting elements that I want to point out are that the distribution frequency is monthly, so it's paying you a dividend monthly from the ETF, and that the 30-day yield, because the yield does change over time, at the moment is roughly 4.07%. Another thing to note is that when the interest rate shifts, the bonds at the longer duration end of the spectrum fluctuate by more than those that are shorter term. And this makes sense for a number of reasons. First of all, the rate on shorter term bonds matches more closely the interest rate right now, whereas the yield on longer duration bonds, so let's say you took out a bond for 10 years, there's a lot more speculation that goes into the yield that you're going to get over that term. Right, so the reason that I like this particular form of investment right now is that the duration of bonds that we are indirectly invested in should do quite well when interest rates fall. At the same time, we're being paid a monthly dividend on a rate that is decent, and the risk of default on these bonds is incredibly low. For those reasons, this is an area that I would like to park some of my money in my portfolio for the next year, year and a half or so. All right, moving on to our regular scheduling, what moved the market last week. I did put out a post last week that mentioned a lot of the key items that happened at a macroeconomic level, at least until that point in time. However, the things that moved the market by far the most last week would have been the unemployment rate in the US coming in quite a lot higher than was expected. as well as the average hourly earnings coming in a lot lower than expected at 0.2%. The reason that markets enjoyed these two pieces of information, particularly in combination, is that it means that the US labor market is starting to cool. Unemployment is starting to tick up and wages are starting to fall at the same time, which means that investors are hoping that the Fed sees less of a need to raise interest rates when it meets later on this month. In addition to that, one of my portfolio companies reported earnings. I only have a very small position in Salesforce at the moment. The company is in a bit of a turnaround. There's been a lot of pressure from outside investors trying to get the company to focus on profitability above growth and revenue. The company has grown the revenue very strongly through the past 2 decades, since it first started really. However, they've poured a lot of the profits of that business into acquisitions and new products, and investors wanted the company to demonstrate that they could turn a strong and growing profit. Well, last quarter it seems that they did just that, so earnings per share came in quite strong versus the expectation, and they increased the forecast for the year. Now, Salesforce is a company that I know incredibly well. I started Europe's largest Salesforce consultancy back in 2011, 2012. I know the technology very well. I know how good they are at growing the business. They're incredible at sales, marketing, as well as the technology that's delivered. So as I mentioned before, if we look at the revenue growth, and this is just going back to 2018, revenue growth has been strong for a very long time. You can see that it's been ticking up nicely, but the net profit has been a little bit more lumpy. However, the forecast net profit based on what the business is doing today looks as though it would be ginormous, record setting through 2024 and 2025. I'm not going to just believe the forecasts. I want to see evidence that the company is on this path and able to sustain this level of profitability. I also mentioned in a post last week that I have increased my position in Canadian solar. I've doubled the size of my holding roughly, and I think that I will add a little bit more through the next week or two. I made a video analyzing CSIQ. I think it's a great company. I'm not going to go into detail about it now. All right, well, what about this week? Today is a holiday in the US. It is Labor Day, and that means the market is closed. However, later in the week, the G20 summit will be hosted in India. It's already stirring the pot a little bit because President Xi from China says that he will not be able to attend. And I think that there was a hope from the leaders that will be attending that they would be able to do more about the conflict in Ukraine, the Russia-Ukraine conflict. Through this week, there's not a hell of a lot in terms of market moving macro data, at least the top tier data, although the initial jobless claims number probably will have the ability to move the market if it comes in a lot lower, a lot higher than expected. And finally, we're going to get earnings for a company that I quite like called UiPath. The stock price has dropped enormously since the business IPO'd in 2021, so it reached a high of roughly $80 per share. It's now $15, $16 a share. However, the company is one of a kind. This is another technology, a software business that I know fairly well. I think that they are going to walk in Salesforce's footsteps and become quite a behemoth through the next decade. I'll do a deep dive on them after they've reported earnings this week. All right, that's it for this week. I hope you enjoy the lovely weather, and I'll speak to you soon. Goodbye.